Once upon a time, what Wall Street now calls shareholder value had another name: market manipulation. If a company used its own money to inflate its stock price, it wasn't smart strategy, it was fraud. Executives could be arrested, companies' finite reputations ruined. Today, that same practice, stock buybacks, is the single most powerful engine of corporate America. They lift markets, inflate CEO bonuses, and quietly transfer trillions to shareholders, without creating a single product or job. So, how did something once considered criminal become the backbone of modern capitalism? Welcome to the financial timeline, where money, power, and history collide, and nothing is ever as simple as it looks. The story of buybacks begins with a collapse. In the roaring 1920s, markets ran like casinos. Executives manipulated their own stocks. Bankers cut insider deals. Everyone wanted to be rich fast. When the crash came in 1929, the tricks that fueled the boom turned deadly. Corporations had used their cash to prop up their own share prices, giving investors a false sense of safety. When panic hit, those same companies were forced to sell shares to survive, accelerating the collapse. By 1933, capitalism itself had lost the public's trust. Factories shut down, banks failed. Unemployment hit 25%. A broken system needed radical change. So in 1934, President Franklin D. Roosevelt rewrote the rules. The new Securities Exchange Act created the SEC and declared one thing clearly: companies manipulating their own stock prices would no longer be tolerated. For the next 50 years, stock buybacks were not banned by name. They were banned by definition. If a company bought its own shares to influence the price, it could be prosecuted. And so, for half a century, the economy grew without this trick. Corporations reinvested in factories, research, and workers. CEOs were builders, not traders. The stock market measured industrial power, not accounting illusions. The system wasn't perfect, but it was productive. Then, in the 1970s, a quiet revolution started, not on Wall Street, but in universities. Economist Milton Friedman introduced a radical idea. The only responsibility of a business is to increase shareholder value. To corporate America, this wasn't theory. It was liberation. Growth no longer meant better products or better jobs. It meant a better stock price. By the 1980s, that philosophy found its political moment. Ronald Reagan championed deregulation. Wall Street soared. Investors wanted higher returns. CEOs wanted bigger paychecks tied to stock prices. They didn't want to improve what the company built. They wanted to improve what the company looked like. Enter 1982. Quietly, with no public debate, the SEC passed Rule 10b-80I, a one-page rule that changed capitalism. It created a safe harbor, allowing companies to buy back their own shares without being charged with manipulation, as long as they followed loose daily guidelines. In one stroke, the SEC legalized what generations of regulators had banned: the right for corporations to inflate their own stock prices, as long as they called it returning value to shareholders. The results were immediate and seismic. Before 1982, buybacks were rare. After 1982, TA exploded. By the 1990s, over $100 billion a year. By the 2000s, standard corporate practice. By the 2010s, over $1 trillion every year. Here's why buybacks work so well. When a company repurchases its own stock, the number of shares available shrinks. Fewer shares equals higher earnings per share, even if the company didn't earn a single extra dollar. On paper, the company looks more profitable. Stock prices rise. CEO bonuses soar. No new products, no new jobs. Just math. It wasn't capitalism. It was accounting as alchemy. Wall Street loved it. After the 2008 crisis, taxpayers bailed out the banks. Then those same banks spent the next decade using profits and borrowed money to buy back their own stock. Between 2009 and 2019, the top 500 U.S. companies spent $6 trillion on buybacks, more than they spent on all new investment combined. Buybacks don't build resilience. They build illusions. They make markets look strong until they aren't. But governments, embraced them too. Rising stock prices became political propaganda. Proof of stability, proof of competence. In the new order, as long as the stock market stayed high, nobody dared say the patient was sick. By the 2010s, buybacks weren't a tool. They were culture. Profits no longer funded innovation. They funded appearances. Airlines, retailers, tech giants, entire industries turned inward, feeding on themselves. The pandemic exposed the weakness. Companies that spent years inflating stock prices suddenly begged for bailouts because the extra cash they claimed to have was already gone, converted into share price highs, into bonuses, into ilusiones. Every buyback enriches the shareholders who already own most of the market, the wealthiest 10%. Workers got stagnation. Executives got windfalls. The ladder to prosperity still existed, but the rungs disappeared, and as wealth concentrated, markets became addicted to buybacks. Instead of investing in the future, companies borrowed against the future. Corporate debt doubled from 2010 to 2020, yet stock prices soared on the back of a shrinking share count, not growing value. What used to be manipulation became monetary policy. History has seen this before. Cheap money, inflated stocks, faith in endless growth. It ended the same way in the 1920s. When an economy values appearances over productivity, collapse becomes a matter of timing. Buybacks were supposed to show confidence. Instead, they showed companies no longer needed real growth. Why build the future when you can buy the past? The irony is brutal. The same mechanism that once destroyed markets is now celebrated for sustaining them. The deeper you study buybacks, the more they resemble every bubble before them. An economy addicted to its own reflection. When confidence breaks, the illusion breaks with it. Stock buybacks weren't legalized to strengthen capitalism. They were legalized to make capitalism look strong. This isn't growth. It's choreography, a dance designed to make decline look like success. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.